Hello, everyone. Thank you for joining our webinar today, titled Emerging Markets and Asia, Where Now for 2024. My name is Suresh Mistry. I'm the Head of Sustainability and a co-founder at Alquity Investment Management. Today's presentation will be delivered by Mike Sell, Alquity's Head of Global Emerging Markets. Mike has invested in emerging markets for over 25 years. And for those of you who, like me, find emerging market investment baffling, he has an ability to cut through the noise and focus on the factors that really matter. He's been running the Alquity EM strategies since their inception back in 2014. So today's session, Mike will present for around 15 minutes or so, and then we'll take questions. So please use the chat function at the bottom of the screen to send in any questions and comments. The more the merrier, and if we have run out of time, we will endeavour to ensure we get back to you with answers to any questions we don't cover during the session. So that's it from me from an introduction perspective. I'm going to now, if I can, hand over to Mike. Excuse me for a second. Mike, over to you.
Great. Thank you, Suresh. Good morning, everybody. If we can turn to the agenda, and there are four things that we're going to talk about briefly this morning. Firstly, 2024 is a year of elections, both in emerging and developed markets, and we'll explore what that means for our asset class. We'll then talk about the macro trends, China, India, and elsewhere, then broaden that conversation out to talk about sector trends as well. And then finally, we'll talk about where we see the hidden and overlooked opportunities in emerging markets and Asia. And then we'll go over to Q&A. So let's start on the next slide and look at elections in 2024. So we've already had some that have been completed. In Indonesia, President Jokowi was term limited, and so he couldn't stand again. But Subianto has convincingly won that election, and he represents continuity with Jokowi's policies. Taiwan, similarly, the DPP president couldn't stand again, but the DPP won once more with President Lai taking over. So again, we see continuity there. In stark contrast, we had Turkish municipal elections in the last couple of weeks, and Erdogan lost very badly and much worse than expected. The really interesting thing to see here will be whether he continues on the path of fiscal orthodoxy and monetary orthodoxy, or whether he reverts to being hugely populist. The political risk for us is just too high in Turkey. And so given what's just happened, we continue to have zero weighting there. Moving on to the ones that are imminent, that haven't happened yet. India goes to the polls in the next week. We'll get the results of that in early June. The latest opinion polls actually point to Prime Minister Modi winning more seats than last time. Last time was a very convincing victory. He's predicted to do as well or actually even better this time round. In contrast, South Africa, the ANC are not faring very well. And we could easily see this time votes being lost to the EFF on the left. And ex-President Zuma has also founded a party which will take votes away as well. So we're going to see a lot of noise around the elections. And we're also going to see the ANC potentially doing very badly and possibly getting into a coalition with a very much more economically unfriendly party. So again, there's a lot of risk there, and we've factored that into our much lower weighting in South Africa. South Korea had parliamentary elections, which actually were yesterday. And again, the opposition did better than expected here. So the danger here is that the president is now a bit of a lame duck. And the Value Up program, which was designed to improve Korean corporate governance and to narrow the market discount, is now somewhat diluted given the president has a much smaller mandate. And so that's a marginal negative for South Korea. And then in Mexico, AMLO, again, is term limited. He will be replaced by someone from his same party, Claudia Sheinbaum, later this year. And so we see continuity there as well. Perhaps most importantly, though, is obviously the US election at the end of the year between Biden and Trump. And we've seen some rhetoric already from Trump about tariffs and protectionism. We have Trump-proofed our portfolio already, and we'll explore that in a little bit more, but that's obviously something to keep an eye on. So moving now on to the macro themes and starting with China. But there is a recovery, but it's slow and patchy. This chart shows the composite PMI, and the latest reading is 52.7, which indicates there is some growth. Retail sales for the first 2 months of the year are up 5.5% versus the same period last year. So there's some growth there. Similar story with industrial production, up 7% over that period. This weak and patchy growth gives us significant opportunities as stock pickers. And there are some companies that are doing really well. Tongcheng Travel, which we own in our portfolios, had their sales grow 80% last year, reaching a record level of sales and profit, despite patchy recovery. But the problem in China is the consumer, and that is driven by the weak property market. The residential property market saw an almost 33% decline in sales in the first 2 months of this year versus the previous period, which is very substantial. And for this reason, and the geopolitical and country-specific political risks, we're actually quite cautious on China, and despite the valuations, have an underweight weighting there. It's very much about the stock picking in that market. In complete contrast is India on the next slide. We have on the left-hand side, the purple bars represent quarterly GDP growth. The latest print was 8.4%, very strong number. The blue bars represent forecasts of annual growth for the next couple of years, well above 6%. The strong data in a more frequent basis supports this. The latest PMI number was 61.8. And we're just back from a 4-city, 52-company meeting trip around India. And corporates are all supporting the strong growth outlook that we see here in this macro data. On the right-hand side, the blue line is interest rates, the red line is inflation. Inflation is well controlled. Interest rates should start coming down in the next few months when the Fed starts cutting. So the Indian macro environment remains very, very strong, and it's an area that we continue to be excited about. Elsewhere in emerging, I think it's helpful to split things between cyclical and structural opportunities. On the cyclical side, Taiwan and Korea are very tech-dominated markets, and we'll talk about that in a second. Elsewhere, Brazil has now seen 300 basis points of interest rate cuts since last summer. They've not waited for the Fed, they've started cutting aggressively already. That's having an effect on the economy, a positive one, and we expect to see another 100 basis points of interest rate cuts still to come. Unemployment has declined from 8.6% to 7.8%, so that will support domestic consumption. So we're positive on Brazil cyclically. Thailand's been very slow to recover from COVID because tourism is such a large part of GDP. It was between 11 and 12% pre-pandemic. And tourists are now coming back, but Chinese tourists have only reached 50% of their previous number. So it's a slow recovery, but it is here. Now, on the structural side, demographics is a key driver of growth. Egypt has a young population, 111 million people in total. Bangladesh, 170 million people. Indonesia, 275 million people. Very strong growth purely from the demographic dividend that we have. In Saudi, we have reform, but it's also interesting that the average age of a Saudi Arabian is pretty much the same as an Indian, at about 28, 29 years old. So again, you have that demographic boost there. The Vietnamese story, we'll talk about it in a moment, but is again accelerating. Perhaps more surprisingly is Poland. Poland actually benefits from lower wage costs than elsewhere in Europe. So manufacturing in Germany, Holland, etc., is increasingly moving to Poland, and that is why it's a structural story that we see there. So let's now broaden it away from macro into the sectors on the next slide. And the story of the last year in all markets has been AI. And the chart on the left shows expectations for growth in AI hardware over the next decade. 24% compounded growth is expected. Now, NVIDIA in the States is the poster child, perhaps, for AI, but there are a number of companies in Asia, particularly in Korea and Taiwan, that are also crucial to NVIDIA's success, and thus are very strong beneficiaries of this AI trend, such as Taiwan Semi, Hynix in Korea, and ASML, which is European listed, but the majority of its sales go to Asia. These companies are significant market leaders and have a sustainable competitive advantage. There are also some smaller companies, such as Lino and Park in Korea. They're much less well discovered, and they supply to the major foundries. They also have very strong moats. So there's a lot of really exciting stories playing this sector theme. And on the next slide, you can see that that's beginning to be recognized. This shows performance sectorially for the emerging market index over Q1. And IT, which is these tech hardware companies that I mentioned, delivered the strongest returns, 9.9%. And we fully participated in that. Energy was actually the second best performing. We have zero exposure there, as we do not invest in hydrocarbons given our ESG process. However, that didn't cause us any problems. We're able to benefit from Saudi Arabian or UAE consumer companies that did very, very well for us. That doesn't hurt us in the slightest. Perhaps interestingly, real estate is the worst performing sector in the quarter. And this is something that's quite interesting to us. At some point in the near future, the Fed will start cutting rates, despite the slightly higher inflation print last night, and emerging market countries will follow. And so we're looking and have identified some really interesting opportunities, particularly in Indonesia and India in the real estate segment. On the next slide, we just want to reaffirm that despite the strong performance of tech and AI, which we fully benefited from, our portfolio remains focused on the domestic structural growth opportunities. That is the story of emerging markets. It also means it's not linked to whatever may or may not happen in the US later in the year. So whether that's online travel, such as Despegar in Latin America, or Make My Trip or Lemon Tree in India, e-commerce, such as Jahez in Saudi Arabia, or Full Truck in China, or a retail, HomePro in Thailand, Phoenix in India, Forlis in Greece, FPT in Vietnam. These are the multi-year and perhaps multi-decade structural growth stories that benefit from the inherent growth potential that we see in emerging markets. And we're very excited about the potential that we see there in the coming years. Now, moving on to the next topic, which is the overlooked opportunities that we see. My colleague Kieran has just traveled to 4 ASEAN countries, meeting with over 45 companies there. And ASEAN is perhaps the biggest single overlooked opportunity. Within that, Vietnam is showing significant improvement after a really difficult couple of years. The chart on the left shows foreign direct investments, which again has now surpassed the 2019 peak. We have low interest rates, improving export growth, and favorable government policies. Vietnam is being slated for potential inclusion in some emerging market indices, which will result in a potential further re-rating of the market. Now, Vietnam's a major exporter, so Trump is a risk. But in this case, the positives absolutely outweigh the negative factors. And so we're quite excited about Vietnam. And the other one in ASEAN will be Indonesia. Given the elections have been more decisive than expected, confidence is going to increase there, and we favour banking, retail, construction, and property in that market. Outside Asia, Saudi Arabia is still under-owned by investors. We see that as an overlooked opportunity, as well as Greece and Egypt. So now, moving on to valuations. This chart shows the 20-year trailing price to book of emerging markets versus developed markets. And emerging continues to derate versus developed markets. Very simply, we have never been this cheap in 20 years. Despite the structural opportunities, the cyclical growth we're seeing, people have lost some confidence in emerging. It's very much ripe for a turnaround in our view, given the opportunities that we see. And on the next slide, we look at emerging markets versus its own history. So this is the 10-year trading price to book of emerging markets, and we're bang in line with the average. Again, this doesn't take account of the structural growth we see in some countries, the cyclical tailwinds driven by the US and cutting rates, and strong growth in a number of emerging countries for either cyclical or structural reasons. So we also find emerging markets very attractive versus its own history. Now, what have we done in the portfolios over the last year on the next slide? Well, the most significant move is a reduction, which is to reduce China. Number of reasons for this. The economy's growth, whilst there, is slower and patchier than we would have hoped. Geopolitical issues are not going away anytime soon, not while President Xi is in charge, and he will be for the foreseeable future. And the economy is being increasingly politicized. Therefore, we are underweight China, and in our view, it's a stock picker's paradise where we can find some great companies like Tongcheng or Full Truck that will deliver strong alpha for us whilst in an overall underweight context. We've also reduced South Africa ahead of the elections for the reasons that I spoke about. We've added to Taiwan, India, and Brazil, and in the smaller markets, Vietnam, United Arab Emirates, and Malaysia. So how have we done? On the next slide. Well, it's very pleasing that where we've been very different from our peers and or where we've added, such as Taiwan, Saudi, and Vietnam, they've been some of the biggest positive drivers of our performance. So our differentiation really does add value. On the negatives, the biggest negative has been China. The recovery was slower than we expected. But equally as important was the stock market has been driven by government-linked companies in the short term, not the quality growth private sector companies. It's the latter that we invest in because over the medium term, they are the ones that will consistently deliver returns for shareholders rather than do the government's bidding. However, that wasn't the case in the short term, and that was painful. Elsewhere, the Thai recovery and the recovery in e-commerce companies in Southeast Asia has been slower than we hoped. We've stuck with these views. We can see it coming through. It's just taking a bit longer. So finally, to conclude, the global headwinds that we've seen in the asset class have dissipated. The Fed will be cutting rates in the near future. Given the number of elections we have this year, asset allocation is really going to matter, and we've already positioned ourselves accordingly. Our portfolio is dominated by domestically focused companies, plus some exceptional exporters, such as the AI theme. This means we're exposed more than many to domestic structural growth in emerging markets and much less exposed to any risk from Trump or tariffs or geopolitical noise on that front. And we are really able to find lots of great sector and company opportunities. Valuations are super attractive versus developed markets and are certainly attractive versus their own history. So as we move into the rest of this year, we're really, really excited about the potential for the asset class and the stocks and sectors that make up our portfolio. Thank you very much. And Suresh, let's now please turn over to Q&A.
Thank you, Mike. Thank you for your time and great presentation. If we have any questions, the Q&A function allows you to send those through. I have a few come through already. You mentioned about Trump-proofing the portfolio, Mike. Can you kind of give a little bit more detail about how you've done that and what happens if Biden does win? How would you adjust the portfolio to reflect that as well?
Sure. So the big concern with Trump is his talk about increasing tariffs across the board. That's going to impact emerging market exporters to the States. Now, some companies such as TSMC, Hynix, etc., are irreplaceable, and they will continue to do as well as they have done regardless, because the US can't replace them, and so they long-term winners. However, areas like Mexico, if Trump decides to focus there, a lot of the Mexican story has been about exporting to the States, and so there's a risk there, depending on what Trump does, if indeed he wins. So where there's low-end manufacturing, or where there's something that's particularly sensitive to the US economy, there are areas we see as risk, and there are places we want to be a little bit more cautious in the near term until the end of the year when we have some clarity. Now, if Biden were to win again, and I think it's too close to call, then some of these areas, perhaps Mexico, now the elections there will be out the way as well, will come back onto the radar screen. That said, domestic structural growth is the way, in our view, to play emerging markets. It's the most exciting area for emerging markets, and that will always dominate our portfolio. And the high-end manufacturing that is irreplaceable will stay there. It's some of the more esoteric ideas at the margin that will come back into play in that situation.
Okay, excellent. Thanks, Mike. And just broadly, looking at emerging markets at a broader context, you've not mentioned much around Africa on a broader context and Latin America. Can you just give a quick overview of those two overall markets besides the big countries that you've already mentioned, such as Brazil and South Africa?
So taking Latin America, Brazil is where we see the best opportunities, and that's why we have such a large weighting there. Mexico, we have one position there, which is a consumer company. We're cautious there for the reasons from your previous question. The smaller markets, the political risk is too high. We have one position in Chile, but generally speaking, we see the best potential for alpha in Brazil. So that's Latin America. In Africa as a whole, the politics have gone backwards over the last 5-10 years. And so we see very, very few opportunities there at all. In South Africa, we have one very small position, which we've reduced. We have a position in Egypt, which you can debate whether that's Africa or the Middle East. But elsewhere in Africa, apart from that one position in South Africa, we have nothing else. And we don't see any meaningful reform or restructuring anywhere else in the continent that would make us want to change our minds. Now, once the South African elections are out the way, there are a whole bunch of really well-managed companies in that country. The economy's been very weak for an extended period, so there are options there. But even when the elections are out the way, and if they go okay, there's still a lack of catalysts. So I think for us, if you look at the portfolio, bits of Asia are really to Eastern Europe. Brazil is very compelling. Elsewhere, not so much.
Excellent. Just another question come through. ESG has been in the press recently as being, quite challenged in terms of the returns delivered by ESG orientated funds. Can you kind of share how that impacts on the Alquity emerging market funds, and how it actually is it a benefit or is it a detractor from your ability to drive alpha?
Sure. There's such a variety of funds under the impact ESG sustainable lens, and many people in those funds end up owning wind farms or solar. For us, we use that lens to look at the entire universe. So you don't see our portfolios having a bias to wind farms or solar or anything like that. And that's where you've had perhaps a bubble which has deflated. So that doesn't really impact us in the slightest. I think for us in the last year, poorly managed companies in China, as I mentioned, hasn't helped. They've done well. That doesn't tend to last for any extended period. Government-run companies never do well ultimately, and we're very happy to continue to avoid them. But elsewhere, our ESG lens enables us to find companies that are aligned with all stakeholders, with the environment, with workers, with minority investors, particularly on the G side, which I fear is very often overlooked by many so-called sustainable investors. So for us, ESG is a tool for delivering better returns and reducing the risks in the portfolio. You get the odd blip, as with China, but they're few and far between. And so we're very, very positive on the outlook, and the negative sentiment towards that theme doesn't impact us because we look at it in a very different way.
A question, I know you've presented on India quite a bit recently and shared your views. We just have a question around the state-owned enterprises in India and how the market has rallied recently and how you see that playing out over the rest of 2024.
Sure. We focus on what I would guess call quality growth companies, private sector companies that have delivered consistently for investors over 10 years. And that is how we generated in our Indian funds top quartile returns over that decade period. We've had in the last 3 months a shift towards so-called cheap companies, including the public sector companies. That's been a blip. That's now reversed. They look cheap, but they're superficially cheap. Their profits are very determined by the government. I've seen this before in my career. It really doesn't last for any period of time. And that kind of came to an end in the middle of March. And over the last 3 or 4 weeks, quality growth continues to outperform. As we all know, emerging markets is a long-term investment with a 3 to 5 year horizon. And the focus on companies that will continue to deliver over that time frame means that we avoid these ones. And you get a blip here and there, but that never works over time. And so we're very, very happy to avoid poor quality companies that everyone else chases. Avoid the bubbles, stick to the quality. That's what works in emerging.
Excellent. Great. I think we're up for time now, Mike. Thank you so much for today. And all the participants, if you do have any further questions or want to get any more information about the Alquity funds, reach out to Mike, myself, Mark Rugel, who is our head of business development, and we'll be able to answer your questions and send you any further information as you need it. Once again, thank you for joining us and take care, and we'll speak to you again soon. Bye now.